Hi everyone, today we'll be going over accounts, May-June 2022, paper 2-3, question number 1. This is structured paper 2, which consists 4 questions, 2 of 30 marks and 2 of 15 marks. And we are also given a time limit of 1 hour and 30 minutes. And since question number 1 is of 30 marks, we will be attempting to solve this question under 30 minutes. Now, without any further delay, let's get started. K Limited's financial year ended on 31st December 2021. The company's income statement for the year ended on that date has already been prepared, and the following information was available at the year end, meaning that these all information are on the date 31st December 2021. Alright, then we're given additional information. On 1st July 2021, the directors had made a rights issue of 1 ordinary share for every 2 ordinary shares in issue. And the rights issue was made at 0.35 per share and was fully subscribed. We can see that the nominal rate of ordinary share capital is 0.25, meaning that the rights issue was done on premium. So out of 0.35, 0.25 will be that of the ordinary share, whereas the remaining 0.10 will be of the share premium. Now let's have a look at the first question. We need to calculate the profit from operations for the year ended 31st December 2021. In the given information, we can see that we have profit for the year. Alright, so we will be using this information in order to figure out our profit from operations. So what we know is that profit for the year is just the difference between profit from operations and the finance cost. So we need to figure out profit from operations. That's going to be profit for the year plus the finance cost. And we are already given the profit for the year in the above information. Let's substitute that value. So the profit for the year, as we can see, is 99,400. Let's write it down. And now we need to figure out our finance costs. So finance costs are the interest paid. So we will definitely be paying interest on our debentures. So that's 8%, meaning that we will be paying 8% of 120,000 as an interest for this particular year, 2021. So let's record it. That's 120,000 debenture, and the interest rate is 8%, which we can write down as 0.08. Let's have a look above. Then there's bank overdraft, dividends paid, inventory. None of these include any sort of interest rate, so we can just skip it. Then we have other payables, other receivables. No interest are paid on those items as well. Then we have retained earnings, share premium, trade payables, and trade receivables. Again, no interest will be paid. So the only interest that we will be paying for this current year is the interest on debenture, which we already included. That concludes it. So we can easily figure out our profit from operations now. That's just going to be the profit for the year, 99,400, plus the finance cost, 120,000 times 0.08, which results in the profit from operations to be 109,000. Alright, this concludes the first part of this question. Now we can move to the second one. For the second part, we need to calculate the amount raised by the rights issue on 1st July 2021. Alright, so let's have a look at the information regarding the rights issue. We know that the directors made a rights issue of 1 ordinary share for every 2 shares in issue. This just means that for every 2 ordinary shares in the date of 1st July, we gave out 1 right shares, right? But what we know is that we have the ordinary shares at 31st December 2021, not 1st July 2021. And what we know is that this ordinary share capital includes the ordinary share at 1st July 2021 plus the right shares issued at 1st July 2021, right? So out of this value, we will be figuring out our total right shares issued. So what we can say is that the 2 ordinary shares plus 1 right shares in 31st December includes 1 right shares, right? So this just means that 3 ordinary shares include 1 right share. So 1 ordinary share will be equal to 1 by 3 right shares. And the thing to remember here is that the ordinary share mentioned here relates to the ordinary share value at 31st December 2021 as we wrote here. So now we need to figure out the number of shares or number of ordinary shares at 31st December 2021. In order to figure out the number of shares, we just have to divide the total value of the ordinary shares at this particular date divided by the nominal rate. So let's have a look at the total value. So the total value of ordinary share capital is 480,000 and the nominal rate is 0.25. So we can easily figure out our number of ordinary shares. That's just going to be the total value of 480,000 divided by the nominal rate of 0.25, which gives the number of ordinary shares at 31st December 2021 to be 1,920,000. Now we need to figure out of these ordinary shares, how many are the right shares. So in order to do so, we will just be using the unitary method. We already know that 1 ordinary shares means that there is 1 by 3 right shares. So for 1,920,000 ordinary shares, there's going to be 1,920,000 divided by 3 right shares. So this gives the total number of right shares to be 640,000. Now, in this question, we need to figure out the amount raised by the rights issue. So let's figure out the amount in our ordinary share. So ordinary share includes the nominal rate of 0.25. So that's 640,000 times 0.25, which gives the value of 160,000. Now we also know that the right shares were issued at a premium, and we had the ordinary share value 0.25 and the share premium value of 0.10. So let's figure out the value included in the share premium account. So in the share premium, we will have the total number of right shares, 640,000, times the share premium rate of 0.10, which gives the value to be 64,000. So now we need to figure out the total amount raised. So the amount raised by the rights issue on 1st July 2021 is just the sum of ordinary share and the share premium. So that's 160,000 plus 64,000, which gives the total amount raised to be 224,000. Alright, this concludes the second part of this question. Now we can move to the third one. For the third part, we need to prepare a statement of changes in equity for the year ended 31st December 2021. Okay, let's look for the balances at 1st January 2021. In the given information, we have our ordinary share capital at 31st December 2020, and we have our retained earnings at 1st January 2021. So let's record this value, and it amounted to 133,000. Let's write it down. So for retained earnings, that's 133,000. Okay, then let's figure out the transactions that should have been recorded in our statement of changes in equity. Okay, the first one is dividends paid, then profit for the year should also be recorded. Then we have the rights issue. Okay, let's record it in order. We will first record the rights issue, then the profit for the year, and the dividends paid. And those are all of the transactions that need to be recorded in our statement of changes in equity. The first one is rights issue. Then we have profit for the year. Then we have dividends paid. And this gives our final balances or the closing balances. So we can write it down as balances at 31st December 2021. Alright, let's record the value for the rights issue. We already figured out the value for share capital and share premium in the above question. In our share capital, the amount to be recorded by the rights issue is 160,000, whereas in the share premium, the amount to be recorded is 64,000. So let's record these two values. So that's 160,000 in share capital and 64,000 in share premium. Rights issue does not affect the retained earnings at all, so there's not going to be any value. So the total is just going to be 160,000 plus 64,000, which results in 224,000. Now let's record the profit for the year. We are given the profit for the year in our information amounting to 99,400, and the profit is always recorded in our retained earnings. So that's 99,400. And we know that the profit for the year does not affect share capital and share premium in any way. So there's not going to be any amount for those columns, which means that the total will also have the value of 99,400. Now we will record our dividends paid, which is again given in the above information. So the dividends paid amounted to 96,000. Dividends paid are always a part of the profit given to the shareholders, meaning that our retained earnings will be deducted by this particular value. Let's record it. So retained earnings will be deducted by the amount of dividends paid, which is 96,000. And this is a negative value. So we will be recording it in a bracket indicating that this should be subtracted. Again, dividends paid does not affect share capital and share premium in any way, which means that the total is also going to be negative 96,000. Alright, then we can move to our closing balances. And we were given the closing balances of share capital and share premium. So let's have a look above. The ordinary share capital at 31st December 2021 amounted to 480,000. So let's record this value. That's 480,000. Now we'll repeat the same process for share premium. Share premium at 31st December 2021 is given right here, amounting to 90,000. So this is the closing balance. Let's record it in our statement of changes in equity. That's 90,000. Now we need to figure out the remaining values. So the first value that we need to figure out is the opening balances of the share capital. And this acts as the balancing figure now. And in order to figure out the balancing figure, we just have to deduct other amounts from the total one. In this case, that's going to be 480,000 minus 160,000, which results in 320,000. We repeat the same process for share premium. Again, in this case, the opening balance acts as a balancing figure, and in order to figure out that particular value, we need to deduct these amounts from our total. In this case, that's 90,000 minus 64,000, which results in 26,000. Now let's figure out the total for our opening balances. That's just the sum of these three amounts. That's 320,000 plus 26,000 plus 133,000, which results in 479,000. Now we also need to figure out the closing balance of the retained earnings. For that, we need to add these three amounts. That's 133,000 plus 99,400 minus 96,000, which results in 136,400. Now in order to figure this amount, we can do it in two ways. We can either add these four amounts or we can add these three amounts. So in order to check, we will be adding from the both sides in order to figure out whether the amount will be the same. So let's add these three amounts. That's 480,000 plus 90,000 plus 136,400, which results in 706,400. Now let's add these amounts. That's going to be 479,000 plus 224,000 plus 99,400 minus 96,000, which also results in 706,400. That means that our statement of changes in equity is correct. And this concludes the third part of this question. Now we can move to the fourth one. For the fourth part of this question, we need to prepare the statement of financial position at 31st December 2021. Okay, so we will be starting with our assets section. And we will be categorizing our assets into two types. So the first one is non-current assets. Let's have a look at our above information to figure out the non-current assets. Okay, so we are given non-current assets total value at cost as well as the provision for depreciation. And we know that in our statement of financial position, we always record the net book value. And net book value is just the difference between the cost and accumulated depreciation or provision for depreciation. So in this case, the cost is 960,000. And the provision for depreciation or the accumulated depreciation is 170,000. So we just need to deduct this value from the cost in order to figure out the net book value. That's going to be 960,000 minus 170,000, which results in 790,000. So this is the amount at which the non-current assets will be recorded in our statement of financial position. Let's write this value. So that's 790,000. And this concludes our non-current assets section. Now we can move towards the current assets. Let's have a look at the given information and let's figure out the headings to be included in current assets section. Okay, the first one is inventory. And inventory has a value of 49,400. So let's record this. That's inventory with the value of 49,400. Okay, let's look at our information again. Then we have other receivables. Receivables are always assets, and this amounted to 1,400. So let's record this as well. That's other receivables with the value of 1,400. Okay, then we have trade receivables amounting to the value of 18,900. Let's record this in our statement of financial position. Trade receivables. And this was at the value of 18,900. And this concludes our current assets section. So we can figure out our total current assets. That's just going to be the sum of these three amounts, which is 49,400 plus 1,400 plus 18,900, which results in 69,700. Now we can figure out the total assets by adding the value of total non-current assets and total current assets. So that's 790,000 plus 69,700, which results in the value of 859,700. This concludes the assets section. Now we can move towards equity and liabilities section. And since we're preparing the statement of financial position for a limited company, we will be terming our capital as equity. Okay, let's start with the equity section. And for equity, as we can see in our statement of changes in equity, there are three portions. So the first one is share capital, second one is share premium, and the third one is retained earnings. So let's write it down. We have share capital, share premium, and retained earnings. Okay, let's have a look at our statement of changes in equity to write down the amounts. So the amount for share capital is 480,000, the amount for share premium is 90,000, and the amount for retained earnings is 136,400. Let's record these values in our statement of financial position. So that's 480,000 for share capital, 90,000 for share premium, and 136,400 for retained earnings. So now we can figure out the total for equity. That's just the sum of these three amounts. That's 480,000 plus 90,000 plus 136,400, which results in 706,400. Okay, now we can move towards our liabilities section. Let's have a look above. So we can categorize liabilities into two types. So the first one is non-current liabilities. These are the payments that are to be made after a year. So let's see if we have any of those. We have debentures, but we can see that the debentures are to be repaid in 2022, which is next year. So that's within a year. So this cannot be included in our non-current liabilities. This is actually a current liability. And we don't have any other non-current liabilities, so we only have current liabilities. And the first one is going to be 8% debentures amounting to 120,000. Let's record it in our statement of financial position. So we have current liabilities. And the first one is 8% debenture, which is to be repaid in the year 2022, amounting to 120,000. Let's have a look above. Okay, we already recorded this. The next one is bank overdraft, which is again a current liability, and this amounted to 4,700. Let's record this. So we have bank overdraft with the value of 4,700. Let's have a look above again. We have other payables. Payables are always liabilities amounting to 2,700. So let's record this value as well. That's other payables with the amount 2,700. Okay, we already recorded retained earnings and share premium. Then we have the trade payables, which is a current liability amounting to 25,900. This concludes all of the items in our statement of financial position. So let's record it. That's trade payables amounting to 25,900. So now we can figure out the total for our current liabilities. That's just the sum of these four amounts. 120,000 plus 4,700 plus 2,700 plus 25,900, which results in 153,300. Alright, now we can figure out the total equity and liabilities value. So this is just going to be the sum of total equity and total current liabilities, since we do not have any non-current liabilities. So that's just 706,400 plus 153,300, which results in the total value of 859,700. We can see that the total of equity and liabilities and the total of assets is the same amount, meaning that our statement of financial position is correct. So this concludes the fourth part of this question. Now we can move to the fifth one. We need to explain the meaning of each of the following terms. The first one is revenue reserve. Alright, we know that revenue reserve is created from the net profit that a company makes during a financial year or the profit from trading activities. Let's write it down. Revenue reserve is created from the net profit that a company makes during a financial year. This can also be termed as profit from trading activities. And the next important character of revenue reserve is that it is available for distribution to shareholders in the form of dividends. Let's write it down. It is available for distribution to shareholders in the form of dividends. Or we can also say that revenue reserves are distributable among shareholders. For the second part, we need to explain the meaning of capital reserve. So capital reserve is the reserve that is created from capital profits or the profits arising from non-trading activities, right? Let's record it. Capital reserve is created from capital profits or profits arising from non-trading activities. Alright, the second important character of capital reserve is that it is not available for distribution to shareholders in the form of dividend. Let's write it down. It is not available for distribution to shareholders in the form of dividends. Okay, so this concludes the fifth part of this question. Now we can move towards the sixth one. We are given additional information. The new directors of K Limited will require additional finance in 2022 to cover the cost of opening a new branch of the business, and they are considering two options. Option 1 is to make a further rights issue of shares, whereas option 2 is to make an issue of 8% debenture. Now, we need to advise the directors which option they should choose. We need to justify our answer by discussing both the options. Alright, so the two options are the rights issue or the debenture. Let's list down the characteristics of both of these options. So we know that rights issue is a permanent source of capital, and this does not have to be repaid in the future. Let's write it down. Rights issue is a permanent source of capital and It does not have to be repaid. Similarly, debenture is actually a temporary source of finance because it must be repaid in the future. Let's write it down as well. Debenture is a temporary source of finance that must be repaid. Now, thirdly, for a rights issue, we do not require any sort of security or collateral. So, no security is required for a rights issue. Whereas debenture might require some form of security or collateral, as it is similar to a long-term loan. Debenture might require some security or collateral. Then we know that for rights shares, the dividends payment are optional because dividend is a part of the profit, and if the company is going through a loss, then no dividends have to be paid to the right shareholders. Let's write it down. Dividends payment are optional on right shares. But if you're talking about debentures, then the interest on debentures must be paid regardless of whether the company is going through a profit or loss. Let's write it down. Interest must be paid on debentures regardless of profit or loss of the company. Now we need to make a proper decision considering these factors. Personally, I would advise the directors to go with option 1 and make a right share issue. Let's write the decision clearly. So decision is that the directors should choose option 1. Alright, so this concludes the 6th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.